Hi, guys. Welcome to the 31st episode of the weekly trading wrap up, WTW for short, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we're starting with the chart of the S&P 500, the market, and the arrow here denotes the week of June 16th. We had Monday here, Tuesday, Wednesday. We were off on Thursday, and today is Friday. So we basically had a slightly down market over the week. OPEX week, so on Friday you had relatively large volume for the month, for the quarter, I should say. And all in all, it was fairly muted. And nothing really much happened in terms of macro, although it was important. The main driver, of course, is the war in Iran. It's about U.S. involvement in Iran, Israel attacking Iran, and Iran retaliating with missile strikes on Israel. But first, before we get to that, let's talk about the technical picture. Okay, let's put in some moving averages. The blue, 200-day moving average. The red is the 50-day moving average. And coming back up here, we had the death cross, and soon we're going to have the golden cross where the 50 crosses over the 200, and that's bullish. The fact that we're trading over the 200, it's bullish. This setup right here, still bullish. Nothing has been violated. We retested the 200 here, but we haven't even come close to retesting it now, okay? A slight criticism is that the action here is pretty far away from the 50, but that can easily get corrected in the coming weeks. Okay, we can get choppy sideways action, and the 50 will catch up pretty quickly and cross the 200 as well. So we have approaching the highs. War scenario hasn't even moved this market. So everything checks the bullish boxes to a T. So the technical picture is very, very, very bullish. Okay, even though we are closer to World War III, even if America jumps on board and attacks Iran, this market so far doesn't even care about that. This is a very bullish setup. So technically speaking, we are bullish. So let's move on to the macro picture of what happened this week. We had a couple of things happening. Of course, it was the FOMC meeting on Wednesday. Powell, to me, sounded sort of hawkish because he said the economy is doing very well. We're going to keep rates at 4.25%, so no cut. But if you look at the FedWatch tool here, we see that for the next meeting in July, there's like an 83% chance that rates are going to stay the same. Okay, so if you look for all of December, if you go to December, you look at all of 2025, and the odds are 41.5% that we're going to have two cuts. Okay, the first one obviously is not going to be in July; it's going to be in September. 60% chance that the first cut comes in September, and in October it looks like they're going to keep the rate steady, and then another cut in December. Okay, so there's like 41.5% chance, the highest probability to date of two cuts in this year 2025, which is another bullish sign in the market. Okay, so the FOMC really did nothing to assuage any bullishness. Okay, even though he sounded relatively hawkish, he's keeping rates very, very high. And as you know, I think what really hurts this market is keeping rates higher for longer, but not right away. Okay, this summer is going to be probably like summer doldrums coming up. We haven't even hit the 4th of July. Really, after the 4th of July, we're going to see like summer volumes kick in. So listen, we have like here, August till September, we have this whole space here. This is September, this whole space here for the markets to enter the summer doldrum period. Can we go higher? Of course. We can like drift higher, like in a slow drift higher into new highs, especially if inflation goes lower and lower. But more than likely, we're probably in the summer doldrums. We might drift higher, but I don't see any dramatic moves to the upside in the summer. Okay, and if this war continues, and the U.S. attacks, we might have an initial pullback. Okay, so this is what I'm hoping for, like a pullback, maybe to the 200. It'd still be bullish. Maybe cover this gap here. Okay, maybe to 575, 580 level would be very healthy. Okay. So that was the FOMC meeting. What else did we have? We had building permits. Came in at 1.39K. Okay, 1.39 million building permits going down. Okay, this should be worrisome. I mean, if we look at the 5-year picture or even the 3-year picture, you'll see that starting to go down. However, if you go to the 10 years, you see it's still holding relatively high. It's bad when it goes really low, like below, like a million or below. 500K would be very bad. However, we're starting. It's just starting. That's not going to happen right away. Okay, it's not going to collapse right away. Slowly holding. So it's positive, but we should keep an eye out on this. Okay, because building permits are a leading indicator of the housing sector. The next macro thing that we had this week was, of course, initial jobless claims. They came in at 245,000. They're expecting 250. So it's not like in the past where we had one big print and then lower. Like we had one big print 2 weeks ago, another big print last week, and this week it's staying high, okay? Like if you look down the road, like when it stays high, it can stay high for a couple of times and then go drop low. I mean, that's what we're hoping for if you're on the bullish camp, okay? But this staying high is a little bit different than it happened before. If you go to the picture here, you can't really see it, but it won't give us the max. But if it starts to trend higher, it's bad. So far in the summertime, and coincidentally, this happened in the summertime as well, these last 3 big prints in 2023, but then they came back down again. So something to watch out for, but not on the horizon of death. Not even close. So the bullish picture of the market is intact, and so is the macro picture as well that we just looked at, because that's the only macro that came out, okay? So we have the macro, we have the technical picture, we have the fundamental picture. Now, what does the sentiment tell us, okay? So we look at the fear and greed index, and we're down to neutral, okay? I still think it's a little bit broken because market momentum shouldn't be at fear, but the fact is, if we're at neutral, okay, that is even more bullish for the market because it can't drop that much. If you go here, we might be at fear and extreme fear by here if the market drops into the 570 level. So we are at levels where in sentiment, where if we drop, it's going to get so extreme, people are going to panic quickly. They're not going to wait till here to panic. It's going to be a panic here, and then people are going to load up on puts, and then the market's going to probably go higher again. That's why I think we're going to chop around for the next 2-3 months, summertime. But this CNN fear and greed sentiment indicator tells you that we are nowhere near extreme greed. So market is still very bullish sentiment-wise. And if we look at the AAII Investor Sentiment Survey, last week we were pretty neutral, and now we're getting fearful, even though we're at the highs. I guess it has to do with the war. But the war is the bullishness is still normal, but the war this is not a big fear gauge when we're talking about the war that's going to happen. So yet we are still not super uber bullish, so it still supports the bullishness in this market going forward. So we have bullish technicals, fundamentals still bullish, but still positive. I shouldn't say maximum bullish, but still positive, but starting to turn a bit to the negative, but we can't say they're negative. They're still holding up is probably the correct word. We have 2 rate cuts probably happening or expected to happen this year, so that is bullish. And we're at neutral sentiment. So not a lot. We're not falling from extreme greed territory, okay? Because we're literally, the high is 613. We're at 595. We're very close to the highs, and sentiment is neutral. So this is all very bullish for the market, okay? So we have everything covered here in a shortened week, and I'm going to keep this short and sweet because the only other real macro to cover is the war, okay? The war in Iran, and there's a lot to say on that. But suffice to say, maybe I'll make another video this weekend if I have time on just covering the war and what I think will happen and how to approach it as a trader. But because it's going to be fairly long, maybe not that long, but suffice it to say that right now the market is not taking the war into account, is not taking it seriously, let's say, but it tells you that the market is fundamentally strong. If war or potential for World War III is on the horizon. However, temporarily there might be offsides. It might drop the market if, let's say, Trump bombs Iran heavily in the next 2 weeks. The market will drop, temporarily. Who knows? Maybe not. I mean, maybe they see it as a victory will be, very, very positive for the U.S. and for Israel. But regardless, okay, any negative hit to come from the war is brushed away by this market and will probably not result in this kind of action. It won't. It'll probably be a temporary drop before going up higher. This is my view based on the fundamental strength of the market going forward. So we are in bullish mode, both fundamentally and technically. Our macro is building permits, something to look out for, but not devastating yet. Initial jobless claims, something to worry about, but they're not exploding higher. And we saw that sentiment is fairly neutral. So given all these factors, we're still in bullish mode. Maybe we correct a bit going forward, but I don't think it's going to destroy this technically bullish picture. So summer doldrums in the market might keep it in a sideways market, which is what I think will happen, which is my first scenario. The second scenario is bullish. We might go drop lower and drift higher as time comes, maybe penetrating the highs into new highs going forward if we get positive inflation data and everything else, and the war turns out to be positive, etc., etc. Okay, so no denying the bullishness, but it would be safe to have some kind of short exposure, which I have. And longer term, look at rates, because the US 10-year is still relatively high. This is going to be a problem for the market going forward. But from now, blue skies ahead, I guess. Bullishness abounds. So stay strong. Have a net bullish bias. However, you should be protecting a little bit to the downside. And I'll probably come up with a war video over the weekend. Let's see. Anyways, I'll see you later, guys, and looking forward to next week.